Business Law 228. Taxes, Tax Laws, and Tax Administration. Edgardo L. Mag also, MPA. Topic 1. Distinction among tax laws, revenue, regulations, and rulings. Taxation law encompasses the legal rules and principles governing the assessment, collection, and enforcement of taxes by governmental authorities. The core distinction lies in the origin and legal authority. Tax laws, like the NIRC, are the foundational laws passed by the legislative branch that create the tax system itself. Revenue regulations are administrative rules issued by the executive branch to implement and enforce the tax laws in detail, and have the binding effect of law so long as they do not contradict the law. Rulings are official interpretations of the law for particular scenarios, providing guidance to taxpayers and personnel but generally not having the broad, binding presidential authority of regulations, except for the specific taxpayer who requested a private ruling. Topic 2. Tax, its elements, and classification and the principles of a sound tax system. Tax is a mandatory financial charge governments impose on individuals or entities to fund public expenditures. Elements of tax. Taxpayer, the individual or entity required to pay the tax. Tax base, the object or activity being taxed, such as income, property, or goods. Tax authority, active subject. The active subject is the entity empowered to impose and collect the tax. Taxable event. The taxable event is the activity or occurrence that triggers a tax. Liability. Classification of tax. Taxes can be classified in several ways, including direct versus indirect taxes. Direct taxes are levied on income or wealth and paid directly by the taxpayer, while indirect taxes are imposed on goods and services and collected by intermediaries. Taxes on what you earn, individual income taxes, corporate income taxes, payroll taxes, and capital gains taxes. Taxes on what you buy. Sales taxes, gross receipts taxes, value-added taxes, and excise taxes. Taxes on what you own, property taxes, tangible personal property taxes, estate and inheritance taxes, and wealth taxes. Progressive, regressive, and proportional taxes. Progressive taxes take a larger percentage of income from high-income earners. Regressive taxes take a larger percentage from low-income earners, and proportional taxes apply the same rate to all income levels. Principles of a sound tax system. The principles of a sound tax system generally fall into two main categories. Economic principles, often associated with the tax foundation, and traditional public finance principles, often used in a governmental context. Economic principles of sound tax policy. These principles are designed to ensure the tax system is effective and minimally harmful to the economy. Simplicity. Tax codes should be easy for taxpayers to comply with and for governments to administer and enforce. Transparency. Tax policies should clearly and plainly define what taxpayers must pay and when they must pay it. Hiding tax burdens in complex structures should be avoided. Neutrality. Taxes should neither encourage nor discourage personal or business decisions. The purpose of taxes is to raise needed revenue, not to favor or punish specific industries, activities, and products. Stability. Taxpayers deserve consistency and predictability in the tax code. Governments should avoid enacting temporary tax laws, including tax holidays, amnesties, and retroactive changes, and strive to establish stable revenue sources. Traditional public finance principles. These principles, sometimes referred to as the canons of taxation, originally formulated by Adam Smith, are widely used, particularly in a government administration context. Fiscal adequacy. Sources of revenue should be sufficient to meet the demand for public expenditure. Administrative feasibility. Tax laws must be capable of convenient, just, and effective administration. Theoretical justice. Consider the taxpayer's ability to pay. Principle, exemplified with progressive tax system. Topic 3. The power of the Bureau of Internal Revenue. BIR, and the Commissioner of Internal Revenue. CIR, and the non-delegated power of the CIR. Tax administration is the government function and process responsible for managing, executing, applying, and enforcing the tax laws within a specific jurisdiction. The power of Bureau of Internal Revenue. The Bureau of Internal Revenue, BIR, is responsible for assessing and collecting national internal revenue taxes, enforcing penalties, and executing judgments in its favor. The power of Commissioner of Internal Revenue. The Commissioner of Internal Revenue, CIR, has broad authority, much of which can be delegated to interpret tax laws and decide tax cases. Powers also include obtaining information, examining records, making assessments, and imposing additional requirements for enforcement. Non-delegated power of the CIR. Certain critical powers of the CIR are non-delegable. Recommending rules and regulations to the Secretary of Finance. Issuing new rulings or changing existing ones.